Ever see a stock ticker like, say, 4, and just wonder what's really going on at that company? Well, today we're doing exactly that. We're diving deep into Shift4 Payments.
Yeah, not just the headlines. We're looking at it from a value investing angle, really trying to understand the business as of today, April 27th, 2025.
Our mission basically is to unpack Shift4. What do they do? How do their finances look? Who's running the show? And, crucially, what are the risks and opportunities? We've got a stack of research ready.
And just for context, the stock closed at $80.28 last trading day, April 26th.
Okay, so here's the plan. 7 chapters. We'll start with understanding the business itself.
Then we'll look at management, financial health.
And in the second half, we'll cover market sentiment, ownership, the big risks, including those 2025 tariffs everyone's talking about.
And finally, we'll wrap it all up with a conclusion. By the end, you should have a much clearer picture of Shift4.
Let's jump in. Chapter 1, Business Understanding. So what's the core of what Shift4 actually does?
At its heart, Shift4 provides a technology that helps businesses manage commerce. Think payments, basically.
Right, but it's more than just swiping a card, isn't it?
Oh, yeah, definitely. They have this integrated platform. It combines the payment processing part with software, even hardware sometimes. It aims to be a one-stop shop.
Integrated, okay. So how do they make money from this setup? Is it mostly recurring?
It is, yeah. Primarily recurring. The lion's share comes from processing fees, a small percentage of the payment volume or a fee per transaction.
Mm-hmm.
And then they also get subscription revenue from software like SkyTab and Lighthouse. In 2024, payments were nearly $3 billion, and subscriptions added about $340 million.
Wow, okay, so significant numbers. What are some of the key products driving that? You mentioned SkyTab.
Right. SkyTab is their big point-of-sale or POS solution, especially popular in restaurants and venues. Think mobile ordering, contactless payments, that kind of thing.
And they connect with other software, too.
That's a huge part of it. Over 550 third-party integrations. So a restaurant could link their online ordering, their payment system, maybe their accounting software, makes everything work together smoothly.
That sounds incredibly sticky for a business, hard to rip out once it's in.
Exactly, high switching costs. They also have an e-commerce platform, Shift4 Shop. They bought a company called Threadcart for that.
Ah.
And for bigger places like stadiums, they have SkyTab Venue. Handles tickets, concessions, merchandise, the works.
So real specific solutions for different types of businesses.
Yes. Plus, business intelligence through their Lighthouse platform, top-notch security features EMV, encryption, tokenization, and value adds like gift cards or even crypto donations via the Giving Block, another acquisition.
Okay, they've got a lot going on. How big are they in the U.S. market?
They're actually a leading independent provider if you measure by payment volume processed, billions annually, serving over 200,000 merchants.
200,000 merchants, wow.
Yeah, in 2024, their end-to-end volume hit $165 billion. Just Q4 alone was nearly $48 billion, so serious scale.
Where are they strongest? Which industries? Still mainly restaurants.
Hospitality, hotels, food, and beverage is still a stronghold, but they've expanded massively into retail and especially sports and entertainment. Think Las Vegas casinos, Allegiant Stadium.
So they've diversified quite a bit.
They have. Restaurants are now less than a third of their volume. Shows they're not just a one-trick pony anymore.
So if I'm a business owner, why pick Shift4 over, say, someone else? What's the main draw?
Simplicity, really. That's the core value proposition. Getting everything, hardware, software, processing from one vendor instead of juggling multiple relationships. It aims to cut complexity, potentially lower costs, enhance security, and it's tailored for specific industries.
Makes sense. One throat to choke, so to speak.
Well, hopefully not choking, but yeah, one point of contact.
Okay, let's zoom out a bit. What's happening in the wider payments industry? What are the big trends?
It's a really dynamic space. Integrated payments are huge payments baked right into business software. Everything's moving digital, obviously.
Right.
Businesses need omni-channel capabilities online, mobile, in-store, has to work everywhere. There's a lot of consolidation, M&A activity.
Like Shift4 themselves are doing.
Exactly. We're seeing huge growth in specific verticals like sports, e-commerce, cross-border payments are becoming more important. And security, data security, is always top of mind. The overall digital payments market is forecast to be massive, like $16.6 trillion by 2028.
16 trillion. That's a lot.
It is, although things like tariffs can throw a wrench in global trade dynamics, which impacts parts of this.
We'll definitely come back to tariffs. But first,
Right.
competition. Who are they up against?
It is fiercely competitive. You've got the huge incumbents, Fuzzr, Global Payments, FIS WorldPay, then the integrated players like Etienne, Block, formerly Square, Stripe, PayPal, even more specialized ones like Toast in Restaurants or Corpay.
So, a crowded field. How does Shift4 stack up size-wise?
Their market cap is smaller than the real giants. They differentiate by focusing on niches, specific features, maybe price, and that big partner network. Direct financial comparisons are tricky, different models and all that. But they position themselves against both the old-school processors and the newer integrated guys, really pushing that bundled advantage in their key verticals.
And presumably there's a ton of regulation in this space.
Oh, absolutely. It's highly regulated. Federal, state, local, international rules. Financial services laws, anti-money laundering, KYC, anti-bribery stuff, sanctions lists, data privacy like GDPR and CCPA, consumer protection.
Wow.
Plus, crypto regulations now, industry standards like PCI DSS for card security. And being public on the NYSE means SEC reporting. Non-compliance is expensive, damaging.
You mentioned an SEC finding earlier.
Yes, related to disclosures about transactions with related persons. A real example of regulatory risk hitting home. But this complexity also acts as a barrier to entry.
Right, keeps new players out. What are the main barriers?
Well, the cost of building the tech infrastructure is huge. Navigating all those regulations we just mentioned. You need scale, network effects, even indirect ones through software partners. Significant capital investment. Building brand trust. And replicating their 550-plus software integrations, that takes serious time and effort.
Okay, so those barriers help protect them. Does that translate into what investors call an economic moat, a sustainable advantage?
That's the million-dollar question, or maybe billion-dollar, given the market cap. A moat protects profits long-term. Shift4 might have a few sources.
Like what?
Brand strength? Maybe. They're known in hospitality and venues. Partnerships with Great Wolf, the Trailblazers, the Raiders help. Isaacman's high profile, too. Morningstar doesn't give them a formal moat rating, though.
Okay, what else? Cost advantages.
Possibly. Processing $165 billion in volume should bring economies of scale. Their integrated model and M&A strategy buying customers can be cheaper than finding them organically likely contribute. Analysts mention their efficient distribution.
Network effects. More users attract more partners.
Indirectly, yes. More merchants on the platform make it more appealing for independent software vendors, the ISVs, to integrate. And more integrations make the platform better for merchants. A virtuous cycle, potentially.
But you mentioned switching costs earlier as being key.
I think that's potentially their strongest moat source. If a business is deeply embedded with Shift4's POS, hardware processing analytics, switching is a massive pain. Data migration, retraining staff, new hardware, operational risk. It's costly and disruptive. That integration really locks customers in.
Any unique assets they have. Proprietary tech.
Yeah, their own tech, Stack the Gateway, SkyTab, Lighthouse. Deep expertise in specific verticals, especially venues. Their proven ability to buy and integrate companies is a capability in itself, that huge partner ecosystem, 550-plus integrations, and their security tech.
So summing up Chapter 1, how hard is it to copy what Shift4 does?
Pretty tough, I'd say. It's the combination. Vertical integration in specific niches, the ISV network, the M&A engine, and those high switching costs. They're an acquisition machine that makes itself very sticky. Table 1 in our notes shows high growth, but PE is varied versus peers.
Got it. Okay, that sets the stage nicely. Let's move to Chapter 2, management evaluation. Who's been steering the ship?
Well, historically, it's all been about the founder, Jared Isaacman. Started it at 16, CEO for 26 years, led impressive growth, lots of acquisitions, took it public in 2020, even beat their 2021 Investor Day targets.
Plus, he does other stuff, right? Aviation, space travel.
Exactly. Draken International, the Inspiration 4, and Polaris missions. And interestingly, his past personal stock purchases have often looked well-timed.
But there's a big change coming, isn't there? He's leaving the CEO role.
That's the major news. He's been nominated as NASA administrator, so likely later this year or early next, assuming Senate confirmation, Taylor Lauber takes over as CEO.
Taylor Lauber.
He's been president since 2018, involved in the IPO strategy, so an internal promotion provides continuity. Isaacman stays the largest shareholder, huge economic interest, though maybe less voting power eventually.
But still, losing a founder CEO after 26 years? That's a big deal.
Huge. Creates uncertainty, execution risk. Isaacman was known for his deal-making skills. Lauber and the team Disman, Frankel, M. Isaacman are experienced. A deep bench, they say, but it's definitely a transition.
How have they handled crises? like COVID.
They navigated the pandemic well, even did a virtual IPO during it. Now they're dealing with these 2025 tariffs. But the big issue historically was that SEC finding we mentioned.
Right, the related person transactions. Tell me more about that.
Between 2020 and 2022, the SEC found they didn't properly disclose compensation over $120,000 paid to Isaacman's siblings and children. Led to a cease and desist order, indicates, a lapse in governance and compliance right after they went public.
Not great. What about communication generally? Are they transparent?
They do the standard stuff. Earnings calls, investor days, letters, website. But those SEC disclosure failures, and maybe some perceived guardedness from Isaacman during his NASA hearings about ties to Elon Musk, it clouds the picture a bit.
And ethically, beyond that SEC issue.
They talk about their Shift4 Cares Foundation, the trust value. Isaacman's philanthropic work is visible, but the SEC finding is a significant ethical question mark at the corporate level. And the scrutiny Isaacman faced over potential conflicts with Musk, SpaceX, and NASA contracts adds another layer. No other major scandals, but these points are important.
So the classic question, is management honest, capable, and shareholder-oriented? What's the verdict?
Capable, yes. The track record under Isaacman shows growth, M&A success, resilience. The incoming team is seen as capable, too.
Honest.
That's where it's clouded. The SEC issue from 2020-22 is a definite concern regarding past practices. Isaacman's Senate testimony also raised questions for some.
And shareholder-oriented.
Isaacman's massive stake aligns his interests financially. Their focus on growth, adjusted EBITDA, share buybacks generally aims to boost value. But the past related party stuff, potential conflicts, and especially that multi-class share structure limiting public vote, those could argue against full shareholder orientation.
So it really feels like a pivotal moment, this CEO transition.
Absolutely. Isaacman's vision and deal-making were so central. Lauber knows the company, but there's uncertainty, amplified by ambitious growth targets like 30% AGR for revenue and EBITDA. The stock price dip after the news reflected that apprehension.
And that SEC finding really stands out for value investors, doesn't it?
It does. It points to a weakness in internal controls or judgment post-IPO, especially within that controlled company structure. Something to watch.
Okay, let's shift gears slightly within management. Capital allocation. How are they using their money?
They invest in the core business, improving SkyTab, Lighthouse, security, getting more merchants, expanding internationally, hiring people. R&D spending isn't always clear, might be capitalized. CapEx is mostly leased equipment and software development.
But M&A seems like the really big piece here.
It's the cornerstone, yes. Buying companies to enter markets, acquire customers often cheaper than organically, add tech, boost volume. You listed some earlier: Shift4 Shop, VenueNext, Finaro, Giving Block, Vectron, Eigen, Givex, Revel.
And the big one pending is Global Blue.
Correct. A $1.5 billion cash deal, about $2.5 billion enterprise value. Huge strategic move into luxury retail and international tax-free shopping. The tender offer got extended, closing expected Q3 2025, financed with cash and a bridge loan. Their ability to integrate these deals is considered a key strength.
Do they return cash via buybacks or dividends?
Consistent buybacks recently, $146 million in FY24, similar amounts before, but no dividends. Focuses on reinvestment, M&A, and those buybacks.
How efficiently are they using all this invested capital? What about return on invested capital, ROIC?
That's tricky. Data sources vary a lot. Morningstar says 8.39%, Fintel 6%. Alpha Spread had an odd negative number. You'd really need to dig into the 10K yourself for a reliable figure.
But what does ROIC tell us generally?
It measures how well they generate profit from the capital tied up in the business. You want it higher than your cost of capital, WACC. Management likely wants to improve it, but we didn't find specific targets. That 8.39% needs context against their WACC.
So are they using capital effectively overall?
Mixed signals. M&A fueled massive top-line growth, market reach maybe cost-effectively. Buybacks, return capital, but it's funded by a lot more debt, especially for Global Blue. That increases risk.
And the ROIC figures aren't stellar.
They're modest, inconsistent in reporting, raises questions about efficiency. Effectiveness really hinges on integrating Global Blue successfully and turning all that growth into sustainable profits that actually exceed the cost of capital.
So a heavy reliance on debt-funded M&A.
Very much so. Contrasts with organic growers like Adyen. Their long-term debt was $2.15 billion at YE 2024, high debt to equity, higher risk tolerance baked in.
Seems like growth via M&A is the priority over near-term ROIC.
Looks that way. Management targets focus on volume, revenue, adjusted EBITDA. All that goodwill from acquisitions inflates invested capital, making high ROIC harder without huge profits. Growth first, maybe superior capital efficiency later.
Okay, Chapter 3, Financial Health. Let's get into the numbers as of late April 2025, mostly using year-end 2024 data. Market cap.
Around $7.1 billion, give or take. NASDAQ seems consistent with the $80.28 share price. Other sources vary slightly.
PE ratio, price to earnings.
This one's all over the place. TTM PE, NASDAQ says 48, Morningstar normalizes way lower at 21. Others range from 22 to 52. Shows how non-recurring items can skew GAAP earnings.
What about forward PE, looking ahead?
More consistent there, around 21 or even down near 17, suggesting analysts expect earnings to grow significantly.
Revenue growth trends.
Strong. FY24 revenue was $3.33 billion, up 30%. Q4 24 was up nearly 26% year over year. An important metric, gross revenue less network fees grew even faster, over 50% in Q4. Future growth expected to be robust too, though maybe slowing slightly from that 30%. There was maybe a slight concern about a sequential dip late in 2024.
Profit margins for 2024. Gross operating net.
Gross margin around 29.2%, pretty consistent. Operating margin varies more, 7.5% to maybe 15%, depends on adjustments. Net profit margin around 6.9% on a GAAP basis, a big jump from 3.4% in FY23. Other sources might show higher net margins, likely adjusted figures.
Debt to equity.
High. Around 2.83 at year-end 2024. Consistent cross sources confirms the high leverage.
And free cash flow. Are they generating cash?
Yes, significant cash flow. Operating cash flow was $500 million in FY24. After CapEx, estimated free cash flow around $310 million. Morningstar has it higher. Adjusted FCF looks strong too, $134 million in Q4 alone. So good capacity to generate cash.
Praise to book.
In the 6.9 to 8.2 range. Morningstar's 6.92 seems reasonable.
Okay, summarizing this snapshot. Profitable with a strong balance sheet.
Profitable, yes. Profitable since 2022, growing net income. But balance sheet is not strong. High debt, high leverage. Cash flow is good, liquidity seems okay, but the debt load, especially with Global Blue coming, is a major financial risk.
And those discrepancies in data, PE, margins.
Highlights the need to understand definitions. GAAP versus non-GAAP. Management loves adjusted EBITDA and adjusted FCF. Analysts use forward figures. Always start with the official SEC filings, the GAAP numbers, but understand the adjustments they make.
So the takeaway is high growth, but fueled by high debt.
Exactly. Rapid revenue and profit growth, strong operating cash flow, but offset by substantial debt, mostly from M&A. That growth versus leverage trade-off is central here. You can see summary in Table 2.
Let's talk financial stability now. Earnings consistency over time.
Well, their public history is short, since the 2020 IPO. Net losses in 2020-2021. Profitable since 2022, with strong growth in 2024 net income. It's a recent consistency, but not a long track record. Growth phase means potential volatility. Nope, none paid. Focus is reinvestment.
Debt management, you said it's critical.
Extremely critical. Over $2.8 billion in debt, end of 2024. Debt to equity over 2, net leverage 2.5 times adjusted EBITDA. Here's a big concern. GAAP interest coverage ratio looks low. Morningstar had it below 1. Calculated, it's also low.
Meaning GAAP operating income doesn't fully cover interest payments.
Potentially, yes, but adjusted EBITDA provides much better coverage, around 9.5 times. Shows their reliance on non-GAAP metrics to justify the debt load. They actively use debt markets notes issued in 2020-21. Debt funds acquisitions, including the Global Blue Bridge loan. Managing this debt is paramount.
Working capital, day-to-day liquidity.
Appears adequate. Current ratio 1.38, quick ratio 1.33 at year-end 2024. Seems stable.
So summarizing stability. Earnings volatile. Excessive debt.
Earnings have been volatile losses to rapid profit growth since the IPO. Debt is excessive by conventional metrics. High leverage from M&A is a primary financial risk. While cash flow seems okay, especially adjusted, the sheer amount of debt increases vulnerability.
That jump to profitability around 2022 is interesting, though.
Suggests successful scaling. But can they sustain that massive FY24 profit growth, up 166%? Acquisitions can dilute margins. Competition is fierce. Sustainability is a question.
And that low GAAP interest coverage is a red flag.
It really underscores the importance of adjusted EBITDA in their story. Investors have to be comfortable relying on non-GAAP figures and the risks of this high-leverage M&A-heavy strategy. Consistent, strong adjusted EBITDA and free cash flow conversion are absolutely essential. Table 3 shows some trends from 2021-2024.
All right, that covers the core financials. Let's take a short break, and when we come back, we'll dive into how the market perceives Shift4, who owns it, and the major risks, including those tariffs.
Sounds good.
Welcome back to our deep dive on Shift4 Payments. We're moving into Chapter 4, Market Sentiment. So how is the market feeling about 4 stock right now, late April 2025?
It's pretty mixed, honestly. There's been recent volatility. If you look back a year or 3 years, performance was strong. But lately, well, since the Q4 earnings, the global blue news, and their investor day back in February, the stock took a hit, maybe 15–20%.
Ouch.
Yeah, and more weakness in March, maybe another 25% drop from the peak. So heading into this analysis state, the shorter-term trend was negative, suggests the market is apprehensive, worried about the big M&A deal, the CEO change, maybe valuation, 2025 guidance.
But some might see that drop as a buying opportunity.
Exactly. It's that balance. Strong underlying growth story versus these significant visible risks.
What about the Wall Street analysts? What are their price targets saying?
Generally still positive, but maybe tempering expectations a bit. Average 12-month targets are somewhere in the $115 to $128 range. That implies pretty substantial upside from the current $80 level.
Any outliers? High or low targets?
High targets go up to $150, $160. Lows are closer to the current price, $70, $82. Interestingly, several firms, Wells Fargo, Susquehanna, Piper Sandler, BTI, Barclays, KBW, actually lowered their targets in April 2025. So some recalibration happening. Evercore ISI just started covering with a hold rating.
But the overall consensus is still buy.
Yeah, the majority maintain buy or strong buy readings. Average recommendation is around 1.60, which signals a strong buy consensus. Raymond James even upgraded to strong buy in March.
What specific news seems to be driving these feelings and actions?
The global blue deal announced in February is huge. Transformative potential international reach, bigger market, but as we said, adds debt and integration risk. The tender offer extension in April kept it front and center, likely a factor in that February stock drop.
And the CEO transition.
Definitely creates uncertainty. Isaacman's NASA nomination, Lauber stepping up, that weighs on sentiment. Isaacman's Senate hearings in April probably added some scrutiny too.
Earnings report.
Q4 2024, back in February, showed strong growth but just missed revenue expectations slightly. The 2025 guidance was seen by some as maybe a bit conservative. That contributed to the drop too. Now, everyone's looking ahead to the Q1 2025 results due April 29th. That anticipation likely adds volatility.
Any positive news? Partnerships?
Yeah, deals with Great Wolf, the Trailblazers, Altera Mountain Company. Those are generally seen as positive reinforcement of their strategy. And analyst actions themselves move the needle.
And the tariffs. Still living.
Yep. Ongoing uncertainty there creates broad headwinds and specific worries for Shift4 about hardware costs.
Okay, let's look at short interest. Are many people betting against the stock?
Yes, short interest is high, really high. End of March, around 8.8 million shares shorted. That's maybe 13% to 15% of the publicly available shares, the float, much higher than the peer average.
So significant bearish sentiment there.
Definitely. Indicates substantial skepticism. Takes maybe 5 to 11 days of average trading volume for all those shorts to cover their positions. It did decrease slightly recently, but still very elevated. Signals doubt, but also potential for a short squeeze if good news hits.
What about options trading? Puts versus calls.
Interestingly, options activity suggests more bullish sentiment. The put-call ratio is low, like 0.30 to 0.36, meaning more call volume and open interest than puts. Suggests options traders are leaning towards the stock going up.
Huh. So short sellers are bearish, options traders bullish.
Seems that way. Also, implied volatility is really high, around 67%. That means the market expects big price swings, often around earnings or M&A news. Any unusual options activity could hint at institutional moves.
So market sentiment is complicated.
Dichotomy is the word. Analysts lean bullish, options market leans bullish. But the stock price action recently and that high short interest shows significant disagreement, significant bearish pressure. It's that tension again. Growth potential versus risks, CEO change, debt, M&A execution, valuation. Likely means continued volatility. And very sensitive to news.
Highly sensitive, especially earnings, M&A updates, CEO news. Analysts are trying to anticipate these. High implied vol confirms the market expects reactions. That Q1 earnings call on April 29th is the next big test. You can see summaries in tables 4 and 5.
Right, Chapter 5, ownership structure. Who actually owns FUR? You mentioned institutions earlier.
Yeah, institutional ownership is incredibly high. So high that reported figures often exceed 100% NASDAQ, says 115%, Fintel 142%.
How is that possible?
It's usually due to short-selling shares being borrowed and sold, but still counted as owned and timing differences in reporting. But the point is, institutions dominate. Over 860 of them own the stock. And the number of institutions and shares held have actually increased recently.
Who are the biggest names?
Based on recent filings, mostly year-end year-end 2024, Vanguard is huge, around 9.4%. BlackRock close behind at 9.0%. Wasatch Advisors around 8.6%. Durable Capital, 7.6%.
Yeah.
Darlington Partners also over 5%. Then Jennison, Fidelity, FMR, Morgan Stanley, State Street, ClearBridge.
Have they been buying or selling? Some shifts. BlackRock, Fidelity, State Street seem to have increased positions. Durable, Jennison, ClearBridge reduced theirs. Shows active management, differing views on the stock's prospects.
What about insiders, management directors?
Founder Jared Isaacman is the biggest by far. Holds about 22 million shares, nearly 25% ownership, mostly via Rook Holdings. That's down slightly from previous filings. His net worth is massively tied to this stock.
Other insiders.
Much smaller direct stakes. The CFO, Nancy Disman, held about 177,000 shares after a sale in March 2025. Yahoo Finance, showing only 1.8% insider holding, probably excludes Isaacman's big indirect stake.
Have insiders been buying or selling overall?
Net selling over the past year, but slight net buying in the last 3 months. Isaacman had some non-open market stuff, equity awards, gifts. He did make an open market purchase in June 2024, and his timing has historically been good.
Other execs.
Some automatic sales, likely part of preset trading plans, 10b5-1, in March 2025. Also, some shares sold automatically to cover taxes on vesting equity awards. Fairly normal stuff.
So ownership is very concentrated then. Isaacman plus top institutions.
Highly concentrated, yes. Isaacman near 25%, top 10 institutions easily hold over 50% combined. This concentration can amplify volatility. Big trades move the price more. And Isaacman's stake gives him huge strategic influence.
How does this impact corporate governance?
Significantly. Because Isaacman controls the majority of votes through those, Class B and C shares 10 votes each, versus 1 for Class A, Shift4 is a controlled company under NYSE rules. Meaning they're exempt from certain governance requirements, like needing a majority independent board or fully independent nominating and compensation committees. And Shift4 uses these exemptions.
So the board isn't majority independent?
Not as of the last proxy, no. They also have a staggered board, makes takeovers harder. And Isaacman held both chairman and CEO roles before the NASA nod. No lead independent director. Power is concentrated.
And it relates back to the SEC disclosure issue.
Exactly. It highlights the potential risk in these structures. Fewer independent eyes scrutinizing things like related party transactions or potential conflicts. The multi-class structure limits public shareholder voting power, entrenches founder control.
So, key takeaway on ownership.
Extremely high institutional ownership, active trading, suggests strong interest, but also potential volatility if sentiment sours. Isaacman's voting control solidifies the controlled company status, bypassing some standard governance rules. Good for founder vision, maybe, but reduces public shareholder influence and independent oversight. That past governance lapse is a clear risk for investors who prioritize governance. Table 6 and 7 detail some holders and transactions.
Okay, Chapter 6, Risk Assessment. Let's start high level with a SWOT analysis. Strengths, weaknesses, opportunities, threats.
Right, Table 8 lays it out. Strength. Integrated platform, strong verticals, M&A skill, ISV network, growth history, improving profits, founder leadership historically. Weaknesses, high debt, M&A integration risk, CEO transition uncertainty, governance concerns, potential margin pressure, inconsistent ROIC, hardware supply reliance. Opportunities.
International expansion, huge with Global Blue, cross-selling, deeper vertical penetration, new products, overall market growth, partnerships, intense competition, macro slowdown, regulatory changes, cyber risks, those 2025 U.S. tariffs, integration failures, especially Global Blue, leadership change disruption, new tech disruption.
You keep mentioning Global Blue. How critical is getting that acquisition right?
Absolutely vital. Success depends on hitting those synergy targets, cross-selling payments into luxury retail, this massive $500 billion volume opportunity they see, aiming for $80 million plus in revenue synergies by end of 2027.
And if they fail?
It severely burdens that leveraged balance sheet. They're paying $1.5 billion cash, taking on debt. Failure limits future options. Plus, integrating is hard different businesses, international complexities.
And these risks are interconnected, right?
Yeah.
Definitely. High debt weakness makes them more vulnerable to a slowdown or pricing pressure threats. CEO transition, weakness threat, could mess up strategy execution opportunities threats. Tariffs threat hit the hardware supply chain weakness. You have to see the whole web.
Let's unpack those 2025 U.S. tariffs properly now. What happened exactly?
Early 2025 saw major tariff actions under IEPA, citing national security, economic emergencies, fentanyl, trade imbalances.
Okay.
Started with 25% on some Canada and Mexico goods, 10% on China, quickly raised to 20%. Then in April, broad reciprocal tariffs, 10% baseline on most countries, with higher specific rates planned for many.
But those higher rates got paused.
Mostly, yes. A 90-day pause on the higher reciprocal rates for everyone except China, Hong Kong, Macau. Baseline 10% stayed, but for China, HK, Macau, the reciprocal rate shot up dramatically 84%, then 125%. Combined with the earlier IEPA tariffs, the total effective rate on many Chinese goods hit 145%.
145%. Were there exemptions?
Some talk of exemptions for semiconductors, phones, certain electronics, maybe books, but overall a massive hike in average U.S. tariffs, lots of uncertainty, and retaliation from trading partners, especially China, imposing tariffs up to 125% on U.S. goods.
How does this hit Shift4 directly?
Hardware costs, POS terminals, payment devices, a lot of that electronics manufacturing is in China or Asia, regions likely hit by tariffs. That potential 145% rate directly jacks up procurement costs, hits their cost of goods sold, maybe customer acquisition if they subsidize hardware.
Supply chain disruption, too.
Yeah, tariffs can mean shortages, longer lead times, needing to find new suppliers or locations. That's complex, costly. Could delay onboarding new merchants or upgrading existing ones. They might have to pass costs to merchants, impacting competitiveness.
Any indirect impacts?
Potentially higher cloud costs eventually, if tariffs hit servers and network gear. Broader economic uncertainty, tariffs are forecast to slow growth. Less spending means less payment volume for Shift4. And the competitive landscape shifts, some rivals might handle it better than others based on their supply chains. Could even spur consolidation.
What about their international plans? Global Blue.
Tariffs and retaliation make global trade more complex, could impact moving hardware or services. Sourcing hardware for their expanding European Asian operations, Finaro, Givex, Global Blue, could be affected by these supply chain shifts. And reduced U.S. imports due to tariffs might dampen cross-border payment volume, a key target area for them.
Has management talked about how they'll deal with this mitigation?
We didn't see specific comments in our research snippets, but likely strategies are diversifying hardware sources, Mexico, Vietnam, maybe U.S., negotiating with suppliers, seeking exemptions, adjusting pricing, focusing more on software, lobbying efforts.
So, overall assessment of tariff risk.
It's a real tangible threat to their costs and profits because they rely on hardware likely coming from tariffed regions. Hits COGS, merchant acquisition. But the silver lining, maybe, is it forces diversification. Companies that navigate this well might build more resilient supply chains and gain an edge long term.
Okay, we've covered a tremendous amount. Let's try to synthesize this in Chapter 7, brief conclusion.
Right. So, Shift4 is clearly at an inflection point. You've got this rapid growth story, big ambitions, colliding with high leverage and significant execution risks.
Strengths and moat.
Integrated platform, strong niches, good M&A track record, ISV network, past growth, improving profits, strong founder leadership historically. Moat seems to come from switching costs, maybe some scale and vertical expertise.
Management and governance.
Isaacman's vision was key, but the CEO transition brings uncertainty. And definite governance concerns the controlled structure, those past disclosure issues.
Financial health.
Profitable, strong cash flow. But the balance sheet is heavily leveraged from debt-funded acquisitions. Adjusted metrics suggest they can service the debt, but the sheer amount is a risk. ROIC needs a closer look.
Key risks and opportunities.
Risks: intense competition, macro worries, regulation, cyber threats, and those U.S. tariffs are a direct hit. The absolute key near-term risk is nailing the Global Blue integration and getting those synergies. Opportunities: international growth, cross-selling, digging deeper into verticals, new products, benefiting from market growth.
So from a value investing perspective.
It's complex, attractive parts. Recurring revenue, switching costs, growth potential. Big concerns. High leverage, governance structure, CEO transition, reliance on M&A. The stock might look cheap relative to targets, but the risks are substantial.
Meaning you need high confidence.
You need a very high confidence in the new management's execution, integrating Global Blue, managing debt, handling tariffs, delivering sustained profitable returns. Margin of safety looks thin right now. You'd need to constantly monitor integration progress, debt reduction, and profitability under the new leadership.
That brings us to our final thought for you, our listener. Given the high stakes of the Global Blue integration and the leadership transition, What single metric or event in the next year will provide the clearest signal of whether Shift4 will successfully navigate its current path and deliver long-term value? Something to ponder.
And hey, if you want to dive even deeper into the numbers, see the financial trends visualized for Shift4, definitely subscribe to the Stock Analytics AI YouTube channel. We've got detailed financial modeling and AI-powered insights there.
Just a standard reminder. Everything we discussed today is based on publicly available data as of April 27th, 2025. We use AI in our analysis, but remember, any investment decision needs your own thorough research and should fit your personal financial situation.
And if you found this deep dive useful, please subscribe to this podcast, The Deep Dive, for more in-depth explorations of companies and trends shaping the business world.